When it comes to classifying intangible assets, there is no agreement on the specific categories. The assets are important and varied. A large technology company, such as Qualcomm, has a market value far exceeding the actual book value that reflects its tangible assets. Important intangible categories make up this huge difference in value, and a big part of this is human capital. The first step to understanding the issue is to clearly define the difference between tangible and intangible assets. As presented in Table 1.1, tangible assets are required for business operations and are readily visible, rigorously quantified, and represented as a line item on a balance sheet. Intangible assets are key to enjoying a competitive advantage in the knowledge era and are invisible, difficult to quantify, and not tracked through traditional accounting practices. With this distinction, it is easier to understand the different categorizations. Intellectual capital was earlier defined as the intangible assets that could be converted to profit. This concept has created a tremendous interest in understanding the impact of the knowledge contribution of successful organizations. Although there are more than a dozen ways to classify intangible assets, some categories are common between the groupings. 3 variations are presented here. A widely accepted grouping is contained in Figure 1.2, where the enterprise is divided into tangible assets, intellectual capital, and financial capital. In this arrangement, intellectual capital is divided into customer capital, human capital, and structural capital. Thomas Stewart, Leif Edvinson, Hubert Senong, and many others support this division. Figure 1.3 shows the elements of intellectual capital offered by another researcher practitioner in the field. This categorization includes research and development, intellectual assets, and knowledge, with knowledge being divided into tacit knowledge and codified knowledge. Still another definition comes from Thomas Stewart, who suggests that human capital has 3 elements. Collective skills. These represent the talents of individuals, colleagues, and teams. This essentially reflects the capability to build on the skills of others. Communities of practice. Organizations are made up of communities, and these communities of professional practice have become a recognized part of business life. The nature of knowledge will require companies to foster communities where there is a high level of candor and where corporate doublespeak has no place. Social capital. What transforms workers into colleagues is social capital. It is the stock of active connections among people, the trust, mutual understanding, and shared values and behaviors that make cooperative action possible. Whatever the definition, human capital is a significant part of intellectual capital, and intellectual capital is an important part of intangible assets. For organizations, especially knowledge-based organizations, intangible assets are often far greater than tangible assets. The bottom line is that we are in the knowledge era. Knowledge comes from humans, not machines, financial resources, or natural resources. The accounting dilemma. One of the problems of attempting to place a value on human capital stems from accounting standards. Both financial accounting, which appears in annual reports, and management accounting, which enables managers to take action, are inadequate for current organizations. Although there has been much discussion, the General Accepted Accounting Principles, GAAP, offered by the Financial Accounting Standards Board, FASB, are inadequate for placing a value on intangible assets, particularly human capital. Even Alan Greenspan, former chairman of the Federal Reserve Board, complained that accounting was not tracking investments of intellectual assets, and that technology change has muddied the crucial distinction between capital assets and ordinary expenses. FASB indicates that accounting's fundamental purpose is to provide information that is useful in making rational investment, credit, and disposal decisions. This is not happening. If the books were communicating stories that investors found useful, then a company's market value would correlate with the value accountants place on it.